Right, so I want to introduce something new to the work that we have done so far, but we are still continuing with the work, except that I'm going to add what is called change. Right, I'm introducing something new called change in accounting policy. Right, change in accounting policy. Right, so there are many different types of policies that an entity can have. For example, policies with regard to depreciation, policies with regard to fair value measurement, etc. Right. However, for this particular syllabus and for this particular topic, right, when we talk about a change in policy, right, when we talk about a change in policy, right, it is with reference to, right, changes in inventory valuation method. Right, so a change in policy in this particular instance is with regards to a change in inventory valuation method. So the other changes in policies, we don't deal with them, right, at this level or in this module. Right, we are very specific. Change in accounting policy here, we are talking about a change in the inventory valuation method. Right, remember there are many different methods of inventory valuation. Right, but in this instance, we are talking about e.g., right, change, right, from FIFO to weighted average cost method, right, or from weighted average cost method, right, to FIFO method. So these are the two popular methods of inventory valuation that we deal with. Right, so obviously a change, right, in inventory valuation method, right, a change in inventory valuation method, right, will result in a change in the value of inventory. Right, will result in a change in the value of inventory. Right, so when you change from the FIFO to the weighted average method, right, the amount of inventory that you're talking about then changes as well. So each method gives a different figure in terms of the estimation of the value of inventory. Now, this has got an impact as follows. So the change in value, right, impacts as follows. Number one, right, the profit for the year. There will be a change in terms of the profit for the year. Right, this is because when you change the value of inventory, either opening inventory or closing inventory, it will then have an impact on the change in cost of sales. So it changes the cost of sales calculation. So remember, when we calculate cost of sales, we say opening inventory plus purchases less closing inventory. So if there is an impact in terms of the valuation of inventory, which means we're changing from FIFO to weighted or the other way around, and the value changes, it is bound to affect the cost of sales, which means there will be a change in the profit for the year figure. Right, it will affect us in terms of the deferred tax calculation. Right, it will affect us in terms of the deferred tax calculation. Right, so we know that deferred tax comes from differences between the value, carrying a value of assets or liabilities compared with their tax base. Right, so if there is a change in value in accounting, right? Write that in full. Right, there's a change in value in terms of accounting, right, which is not accepted, right, which is not accepted, right, or matched by SAS, right? Then it simply means, right, the carrying amount will differ, right, with the tax base, right, leading to temporary difference, right, and deferred tax implications. Right, so obviously in the statement of financial position, right, there will be a change in the closing value of inventory. So it will affect the closing, right, value of inventory. So this we call a change in accounting policy. So that's my theory for now. Any questions on this, good people? Right, are we clear? Right, are we there?
Yes, David.
Right, so we're talking about the change in accounting policy. Right, so let's go through a question. We may not finish it, but to just attempt one or two things. So this is a question from the tutorial letter from the old study guide. Right, so you can see that on the example, right, it says change in accounting policy. Right, change in accounting policy. Right, if we then go to the question, right, it says number A, let's jump number A for now. Right, it says calculate the correct profit before tax in the statement of profit and loss, right, and other comprehensive income of tape time for the year ended 30 September 2014. Then number C, calculate the deferred tax and then calculate the current tax. So these are the items that we're busy answering in the prior weeks. So it's a similar question, except that this time we are adding this impact of change in accounting policy, but we still are attempting to calculate the same things. Right, so I'm going to start with number A here, right, where they say we must do the correct profit before tax amount, right, for the year ended. Right, our year end for this particular question, right, we are looking at 30 September of the year 2014. So we have 30 September of the year 2014. Right, so we want to correct the profit according to that requirement. So I will assume that we are given already the profit before tax, but we need to make some alterations to that profit before tax amount. Right, so we then have profit before tax. Right, so we'll be given that particular amount. Let's go to the question. Let's see what it says. Right, so they say a tape time is a manufacturer of a range of bath products consisting of body washes, power gel, and bath salts, which are sold to various chain stores throughout South Africa. Right, tape time is located in Bloemfontein in the Free State. Mr. Grimm, the newly appointed financial accountant, has prepared the draft annual financial statements of Tape Time Limited for the year ended 30 September 2014. Your assistance is required to finalize the draft financial statements according to the requirements of the International Financial Reporting Standards. The SA normal tax rate changed from 29 in 2013 to 28 in 2014, and the dividend tax rate is 20%. So in this one, there is a change in rate. Right, we already started on the change in rate during the week when we're doing a class with the CTA guys. Right, so therefore there is a change in rate there. The company provides for deferred tax on temporary differences according to the statement of financial position approach. There are no other exempt or temporary differences except those mentioned in the question. There is certainty beyond reasonable doubt that the company will have sufficient taxable profits against which any deductible temporary differences can be utilized. Assume all the amounts are material. Then they say the profit before tax, according to the draft annual financial statements of Tape Time Limited for the year ended 30 September 2014, right, amounted to 1,514,000. The profit before tax includes the following items. So we are given a draft profit before tax, which is 1,514, right, 1,514. So we have 1,514,000. Right, so we need to make corrections. So when you make corrections, you must read through the question and identify instances where there were apparent errors that were made in compiling that profit. Right, where there have been changes that were agreed to at the end of the year, which have not yet been implemented or which have not yet been brought into the books. Right? Or where there was an omission, something that should have been taken in calculating that figure, which was mistakenly not included. So that is what we are looking for in order to correct that profit figure. Right, so we can see that in terms of the profit, they included foreign income, right, which without additional information will be correct. It's always correct to include profit or foreign income, right? At the same time, right, we can see also that there was dividend received, right? We don't really have a problem with foreign income, dividend received being included in profit. It looks correct. If there is a mistake, we'll find out in the additional info, right? And then there is credit losses. We'll find out in the additional info, rent paid, loss on delivery, and depreciation. So it seems like genuine items that you expect to be included in profit before tax. Right, then they give us the additional information. So when correcting profit, you must read through. Foreign income received, right? Foreign income received from Namibia is not taxable in South Africa in terms of double taxation agreement, right? And then Tape Time paid foreign taxes of 148,500. So there is no error that we can pick from there. Foreign income should be included in calculating profit. The SA Reserve Services allows 25% of the allowance for credit losses. Tape Time Limited made no allowance for credit losses in the previous years because the company had no credit sales. Right, again, from an accounting perspective, there is no problem in including a movement in allowance for credit losses. So this amount is correct as it is. No apparent error. The rent paid relates to the rent paid for the factory building and adjacent warehouse. The rent is payable annually in advance on 1 September, and annually increases to the rent are also effective on 1 September, right? When is our year starting and ending? Right, so the year actually ends on 30 September, right? So which means if we are in 2014, our year would have started on 1 October. Right, of the year 2014. Right, then we have rent expenditure here. Right, they've given us an amount of 98,000, and this is what they say. Right, the rent, okay, sorry, let me take out the, right, this is what they say. The rent paid relates to the rent paid for the factory building. The rent is payable annually in advance on 1 September. Right, so our year is ending on 30 September, which means our year starts on 1 October, but the rent is payable on 1 September, and annual increases to the rent are effective from 1 September. On 1 September 2014, the rent increased from 8,000 to 10,000 per month. Right, since our year is ending in September, when we make a payment of the rent, right, on 1 September, we must remember that 1 month is in the current year, and therefore 11 months will be in the following months. So since rent was paid previously at 8,000, 8,000 by 11 would have come before the increase, and then we add 10,000 in the current. That was the effective amount of rental from 1 September. So 8,000 multiplied by 11 plus 10,000. I want to verify my figures. So our expenditure for the current year should be 98,000, right? Which means, therefore, remember 1 month is in the current year. Our year is ending in what? September. But on 1 September, we paid our rent for the full year. It's paid annually at the beginning of September, which means 1 month falls into the current year and 11 months fall into the next year. So it simply means that 10,000 multiplied by 11, right, would have represented a what? A prepayment, which is 110,000, right? However, the expense for the current year is 11 months at 8,000 plus 10,000, which give us 98. So we are happy with what was included in profit before tax, but we are very clear there was a prepayment of 110,000 there. Right, are we clear?
Yes.
Right, then we continue. We don't see any apparent error. Everything looks okay. Then we go to the following is an extract of the asset register of tap time before taking into account additional information 2.2, which you may assume to be correct. So we have delivery vans, we have delivery trucks, we have carrying amounts of these, right? We can see that this is the carrying amount at the end of the previous year. Then carrying amount at the end of the year, this asset is no longer there. Right, so what it means, we probably sold our delivery vehicles before the end of the year. But delivery vans, but the delivery trucks were there in the previous year. They are still there at the end of the year. We are given also the relevant tax basis for the current and the prior year. Right, then they say depreciation on the delivery vans and delivery trucks are provided at 20% per annum according to the straight line method. Right, all the above assets are used for the distribution of the range of bath products to various chain stores throughout South Africa. Right, no error that I saw. Right, during July, the directors of Tap Time decided to replace the only 3 delivery vehicles or delivery vans of Tap Time with 3 larger delivery trucks. Right, this was on July 2013, which was in the prior year. Right, then on 1 October of the year 2013, sold the 3 delivery trucks for 280 each. Right, on 1 August of the year 2013, Tap Time acquired 3 new delivery trucks for 1.2 each, which were immediately available for use as intended by management and put into use. The residual value of the delivery trucks was determined to be nil and remained unchanged. Right, I don't see any error. Right, there was a sale of the delivery vans and we replaced them with the delivery trucks. Let's go to number 3. After the draft financial statements had been prepared for the year ended, the directors decided to change the method of depreciation of the delivery trucks from the straight line method to the reducing balance method at 20% per annum due to the newly improved maintenance. Right, I had not gone through this question earlier, so it doesn't give me only the change in policy, it also gives me, right, the change in accounting estimate. So there are 2 things that I'm highlighting here. Right, the change in accounting estimate as well as the change in accounting policy. Right, a change in accounting policy for this module. Right, change in accounting policy. right, refers to anything that changes the value of depreciation. So this one is a change in depreciation. Right, a change in policy, right, results from, right, it could be a change in method of depreciation. So it could be a change from the straight line method to the diminishing balance method or the other way around. It could be a change in estimate, right, of residual value, right? It could be a change in estimate of the remaining useful life of the asset. Right, so all these will result in a change in accounting estimate. Right, are we clear on what a change in accounting estimate is?
Yes.
Right, right, let's look at accounting for a change in estimate. Right, so we want to look at accounting for a change in estimate. Right, for a change in accounting estimate, right, you must determine carrying amount beginning of the year, right, for the affected asset. Then you apply the changes, right, on the carrying amount at the beginning of the year, right, going forward. This is called a prospective adjustment, which means from beginning of the year going forward. Right, the change in accounting estimate, right, this is adjusted retrospectively. So retrospectively, right, meaning adjustments, right, start in the prior year. Right, to enable a comparison of prior year and current year. Right, based on the same policy. Right, so if we apply a retrospective adjustment, right, it means we also open up the prior year and make the adjustment in the prior year, so that when we present our accounts side by side, prior year and current year, and we do comparison, then the policy is uniform between the 2 years. So that is applicable only to the change in accounting estimate, accounting policy, sorry, which is the change in inventory valuation. But when you have a change in accounting estimate, you have to apply it prospectively from the beginning of the year going forward. You don't open and adjust in the prior year. So that is retrospective adjustment. Right, so we have a situation here in this question, right, where we are being told that there was a change in accounting estimate. Now, the question is, this change that has been implemented by management, right, has it been, have the books been adjusted for the change or not? If the books have already been adjusted for change already, then we don't correct the profit. But if the change has been discussed and agreed to but the profit has not been adjusted accordingly, we have to open the books and adjust the profit. So this is what they say. Right after the draft financial statements had been prepared for the year ended 30 September 2014, the directors decided to change the method of depreciation of the delivery trucks, from the straight line method to the reducing balance method at 20% per annum due to the new improved maintenance policy implemented by TAP Time. Now, this change in the method of depreciation has not yet been recorded in the accounting records of TAP Time for the year ended 30 September 2014. Right, so this change has not been adjusted in the books. Right, remember, this is a change that affects depreciation. We are saying if we implement this, then the depreciation amount for the current year should be changed accordingly. So we need to then have, in our answer here, we are going to deal with a change, right, in accounting estimate. So accounting estimate is a change in depreciation. Right, let's go to the calculations. Let's see how this is supposed to work out. Right, so we're looking at the change in accounting estimate. That is what we are looking at. Right, change in accounting estimate. Right, so when we look at the change in accounting estimate, let's go to the question. Right, remember we've got to figure out the carrying amount at the beginning of the year. Right, this is in particular in relation, right, to the delivery trucks. So we need to go to the information given and say, right, at the end of the previous year, what was the carrying amount of the delivery trucks? So the carrying amount of the delivery trucks in this instance is given. So this is an amount of 3,625,000. So we start from there, we say 3,625,000. Then we say, what is the amount of depreciation that we should recognize in the current year, right, with regard to this delivery vehicle? Now, we must make sure we have the carrying amount at the beginning of the year, because the change is applied on the carrying amount beginning of the year. It doesn't matter if the change is done in the middle of the year or if it is agreed to at the end of the year. We have got to drop back to the beginning of the year. That's why you see this change was agreed to at the end of the year. But we are working with the opening balance, which is the carrying amount at the beginning of the year. So what was the change like? This is what they say. Right, decided to change the method of depreciation of the delivery trucks from the straight line method to the reducing balance method at 20% per annum due to the new improved maintenance plan. So therefore, we are supposed to apply what? 20% per annum, right, as of the beginning of the current year. So therefore, we're going to come here and multiply that by 20%. Right, so that if you say 3,625,000 times 0.2, then we are going to have 700 and what? 25,000. So this is the depreciation, right, based on the reducing balance method. Right, the question is, what was the policy before and what amount did it give us in terms of depreciation? Right, remember now we've got the carrying amount of the current year, of the previous year. We have got the carrying amount of the current year. In terms of this vehicle, the difference between the two, that's depreciation. Right, so this is our depreciation, right, after change in estimate. Right, what was the depreciation amount? Right, before the change in estimate. Right, so the depreciation before the change in estimate, we can calculate easy by simply saying, right, our 3625, which is our carrying amount at the end of the current year, right, less the carrying amount at the end of the previous year, which sorry, current year, this is previous year minus current. So current year is 2875 there. So the difference is depreciation for the year before the change. And the depreciation was 750,000. Right, that depreciation was also provided here. We're just double checking it and also making sure you can calculate that even if it was not given. Right, are we clear on that calculation? Are you understanding it?
Yes.
Right. Okay. All right. So once we have that depreciation, we are now saying, right, the magnitude of the change 750,000 was the previous depreciation before the change. 725,000 is the new depreciation. There is a difference of 25, which represents a decrease in depreciation. So this method is going to lead, the new method, the change is going to lead to a decrease in depreciation of 25. Right, when you decrease depreciation, automatically you are going to increase profit because the 750 is what would have been included here. So now we are saying let's reduce that depreciation by 25. It's actually an increase in profit for the year. Are we clear? Right, are we following?
Yes.
Sharp. So that change in accounting estimates. Right, so now we need to deal with the next item that we can find. So for now, in terms of affecting our profitability, right, we have adjusted for note 2.2. Then we go to the next thing. This one is a change in accounting policy. Tape Time Limited valued its inventory according to the weighted average method after the draft financial statements for the year ended 30 September of the year 2014. Right, for the year ended 30 September of the year 2014 had been prepared. The directors decided to, at a board meeting, to change the current inventory valuation method, right, from the first in to the first out, right? Right, so this is, right, please hold on, someone is communicating in the group. Sorry about that, let's continue. Right, so this one is a change in policy. Let's read what it says. Tape Time valued its inventory according to the weighted average method And after the draft financial statements for the year ended 30 September had been prepared, the directors decided at the board meeting to change the current inventory valuation method to the first in, first out method to give a more realistic presentation of the effect of inflation on the company's profit. The SA Revenue Services will not reopen the previous year's tax assessment, but they will accept the new inventory valuation method for the 2014 financial year. This change in accounting policy has not yet been recorded in the accounting records, so we need to factor this in. These guys were using the weighted average method. They've decided to change to the first in, first out method. So this here is the new, this is the old, and this is the change. So there's been an increase in the valuing of inventory. So what you do with this one, you need to do a calculation in this way. All right, so remember you have been given the changes. If you look closely, you have been given the changes in 2012, 2013, and 2014. All right, so what we then do, we then say 2014 here. We then say 2013 here. Then we say 2012 there. All right, so usually you start by doing the calculation to say the new method minus the old method. So the new value minus the old value. But that has already been done. Right, so you can see that we already have the calculation where they have said the new method minus the old, and they've given you value. So this here represents now what they've calculated. Right, this is an increase, right, in profit. Right, so we then look at that. We then see that we have got 30 to 50. Right, I've started with the latest year. Right, then we've got 16.3 and 14,500. Now, remember, this is an increase in closing inventory for the respective years. Right, this is an increase in closing inventory for the respective years. Right, so an increase in closing inventory will have an impact of increasing profit. Now, remember, when we calculate cost of sales, when we get to closing inventory, we say less closing inventory, which means closing inventory has got the impact of reducing a what? A cost, which is cost of sales. When you reduce the cost, you increase profit. So in each of these years, there's been a increase in the closing inventory, which reduces cost, which means it increases profit. And then we say, what is the tax impact? So we say tax. Right, the tax rate changed from 29 in the previous years to 28. So in the current year now, we say 3250 times 0.28. The impact in terms of tax will be 8470 here. Right, so that therefore our overall increase in profit, right, will be an amount of 21, right, 780. So this is an increase in profit before tax. This is now an increase in profit, right, after tax. Right, so we do the same for the 3 years that we are dealing with here. Right, there's been an increase in all these years on the value of closing inventory. An increase in closing inventory is basically an increase in profit because it reduces cost of sale. So we say 16,300. In the prior year, the tax rate was 29, so times 0.29. So that gives us 4727 minus 16,300. Then we are going to have 11,573. 14,500 times 0.29. Right, then we get 4205. From the 14,500, then we are looking at 10,295. So when we look at the closing inventories only, this is the impact in terms of profitability. Are we clear?
Yes.
But we don't end there, right? We need to recognize that this that we call closing inventory in the year 2013, it will affect 2014 year in terms of profitability, because the closing inventory in 1 year, it is opening inventory in the next year. What we call closing inventory in 2012, it is opening inventory in 2013. So therefore, we are saying when we are in the year 2014 and we want to capture the full impact of the change in accounting policy, we have got to look at both the opening inventory as well as the closing inventory. Right, so we can see that in terms of the closing inventory, now I'm looking at this in terms of 2014, but looking at opening inventory of 2014, which comes from 2013. Right, there was an increase in opening inventory of 2014 because closing inventory of 2013 is opening inventory in 2014. And we are saying that an increase in opening inventory will increase the cost of sales in 2014 and therefore will decrease profit in the year 2014. So this year captures an increase in profit before tax in the year 2014. While this captures a decrease in opening inventory, in profit before tax in the year 2014. So the ultimate impact is 3,250 minus 16,300, which is an amount of 13, right, 950. So the overall impact in terms of profitability in 2014 is that 13,950, which represents an increase in profit in 2014. Are we clear?
Yes.
Right, so we do the same here. So the impact is actually the difference between the three. We do the same with the final profit 21,780 minus 11,573, right, which gives me 10,207. Right, we do the same here. We say 16,300, which is our decrease in profit. Sorry, which is our increase in profit, minus 14,500, which is our decrease in profit. We have 1.8. 4,727 minus 4,207, then we have 522. Then overall, we then say 11,573 minus 10,295. Then we have a figure of 12,78. So this is how you calculate for the change in accounting policy. Right. However, here we are correcting the current year. That's what we are busy with. Correction of the current year. So we need to deal with the change in accounting policy. Right. Remember, we are changing profit before tax. So therefore, we are saying our profit before tax, right, will increase by an amount of 13,950. So therefore, we are going to add 13,950 in correction of our profit before tax amount. Right, so that is what so far we are supposed to do with that information. Right, we need to continue and say, is there any other error that we can pick from the question? There was no other error that was there in the question. So therefore, with our requirement number 1, we will be done. Then we get the correct amount of profit before tax amount. And we'll be now sitting on a figure of 152. Sorry, 1552. Right, 950. And that is the amount that we'll be sitting on. So that's our correct profit before tax. Right, what's our next requirement? Any question? Right, let's go to our next requirement. The next requirement requires the calculation of deferred tax for both years 2013 and 2014. So we are going to look at the calculation of deferred taxation. Right, as usual, we'll have both our years 2013 and the current year. Right, so we need our 4 columns as per the norm. Right, so we have our carrying amount, we have our tax base, we have our temporary differences, we have deferred tax. Right, asset or liability, this time we're using 29%. Right, then we say, what about the current year 2014? Right, in the year 2014, the rate had changed to 28%. So we are going to be using 28% this time. Right, and this is our current year, which is the year, right, 2014. Now remember, when calculating deferred tax, you have got to look for assets, you have got to look for liabilities, you compare the carrying amount with the tax base. So we need to go through the question and say which assets and liabilities can we see. Right, in our initial assessment here on note number 3, right, when we're dealing with the rent, we said we made a prepayment of so much. Right, what is happening with that situation is that when we pay rent, okay, let's do some calculations here. Right, our year is ending on 30 September of each year, but our rent we pay at once for the full year on 1 September, which means when we make the payment on 1 September, right, we are saying the first payment or 1 month or 1/12 is for the current month, and then the remainder is for the next year. It's a prepayment. So since last year, our rent was 8,000 per month, 11 months was prepaid at the end of the previous year, which gives 88,000. Then in the current year, our rental expense was now changed to 10,000, which means 110 was prepaid at the end of the current year. So we say prepaid expense. Then we have 110,000. Then we say prepaid expense here for the prior year, which is an amount of 88,000. Now, a prepayment is an asset to the entity. SARS does not recognize it, especially if it is below 100,000. Right? In this sense, we normally say SARS does not recognize what? Prepayments. Right, which will lead to deferred tax of 25,520. Remember, this is a positive amount. This is a deferred tax liability. Right, this amount, even though it is above 100,000, we'll simply say SARS does not recognize this. Right, we'll then have 110,000. So this is the assumption that we make. SARS does not recognize prepayments and accruals and provisions. It will have always a 0 there. So 110,000 multiplied by 0.28%. So we have 30,800 here, which is a deferred tax liability. Any questions on this, good people? Are we on the same page?
Yes.
Right, so that's the first thing. And then we also saw here that when we deal with this, there is an allowance for credit losses. SARS only recognizes what? 25. This is the first time that we are presenting allowance for credit losses. So therefore, which means this value that we have here, right, which is 32,000, represents the movement for the year. Right, so therefore there was none in the prior year. So we say allowance for credit losses. There was none in the prior year, they said so. The value is 32. And we were told that SARS only recognized 25% of this. So which means according to the policies of SARS, the tax base is that. 32 minus 8,000, that should give me 24, right? Remember, an allowance for credit losses, that's a liability. Multiplied by 0.28, that gives me a deferred tax asset. As long as the temporary differences are negative, or in brackets, then the deferred tax is a positive. It's an asset, it's not in brackets. Right, once I'm there, I then go to the next asset that I can see. Next, I was given the information concerning the delivery vans and the delivery vehicles. Right, the delivery vans were there in the prior year. They were not there at the end of the current year. So therefore, in the prior year, we are going to have delivery. Right, vans. Right, then we were told the carrying amount is given at the end of the prior year, which is 900. And the tax base is also given at the end of the prior year, which is 562, 500. So we have 562, 500. And here it was 900,000. It's an asset. You don't put brackets on assets. Right, which gives us an amount of 337,500. Right, multiplied by 29% in the prior year, we have 97. Right, 875. As long as the temporary difference is positive, the deferred tax is a negative. Right, we did not have those delivery vans, but we did have delivery trucks in the prior year as well. The delivery trucks were given, the value was 3625 in terms of the carrying amount. Then the tax base, it was also given, it was 3593750. Right, then we say 3625,000 minus 3595,750. We are going to have an amount of 29, right? 250, which mathematically is positive by 29%. Right, we are looking at 84, right? 83, if we round off, which is a deferred tax liability. Right, then we go to the current year delivery trucks. Now there's been a change in the value. Right, there's been a change in the value. Right, we have been given the carrying amount here, which is 3593. Okay. It's now all right. I want the carrying amount. I want the carrying amount for the current year. And what did I do? All right. This is the carrying amount that I was given at the end of the current year, which is 28,75,000. Right. Remember, this was based on a depreciation amount of 750,000, but note number 2.2 tells you that there's been a change in the calculation of depreciation, in which case, when we looked at this, we said that the depreciation has reduced by 25. So remember here we had deducted 750, but we are saying we have corrected that. The depreciation is 725. There is bound to be an increase in this value of the asset. We are adding back the depreciation. Are you following?
Can you please repeat again?
Remember, this figure is given. That figure is provided for. So this is the carrying amount at the end of 2014. But remember, there's since been a change in the estimate of depreciation. When we were calculating this figure, it is based on a depreciation of 750,000 rand. Right. However, in our calculations, which we did here, we said the depreciation must now change because of that change, and the depreciation must be what? 725. But remember, we had already deducted what? 750. And then we corrected the depreciation to 725. So there's been a decrease in depreciation of 25 rand. Right? A decrease in depreciation means an increase in the value of the asset at the depreciation.
Okay.
Sharp. Right. Then in terms of the tax base, we have to find out what SARS is going to do with regard to this change that we are implementing. Right, with regard to the change that we're implementing, right, is SARS going to do anything about that? Right, SARS has got its own way of dealing with changes, or sorry, with the tax allowance. So SARS will not be affected here. So which means, according to SARS, we will still maintain this value, which is the tax base, right, at the end of the year, which is 2656250. Right, the change is only in accounting. Right, but here we now have 2.9 according to our own calculations. So 2900,000, right, minus 250, we are going to have an amount of 243,750,000 times 0.28%, which gives us 68,200.
250.
Thank you. Let me check the 24. Did I use the correct rate here? Yes, I did. Right, this is a deferred tax liability. Right here, if it's in bracket, here it's not. If it's not in bracket there, then here it should be in brackets. Right, we are not finished. Then we come to the change in accounting policy. We need to find out what the South African Revenue Services is going to do about the change that we are saying. So this is what they say. The South African Revenue Services will not reopen the previous year's tax assessment, but they will accept the new inventory valuation method from 2014. Right. When we made this change to move from the weighted average method and implement the FIFO, we went back to our books and changed from 2012. But SARS is saying they are not going to allow a reopening of our books. So to them, they will stick with the weighted average method for 2012, for 2013, but they will accept the new method in the year 2014. So Tina, we are now in 2013 because we are showing 2013. We are going to now use the FIFO. But SARS is saying they are not going to make the change in the prior year. They are going to stick to the what? To the weighted average method. So what does it say? In our books now, in terms of the asset of inventory, right, in the prior year, this is for 2013. Right, we are using a figure of 211,300 there. So this is our value based on the FIFO. SARS is saying they are going to stick with what? 195,000 here. So they will have 195,000, right? And then we are saying we're going to have a difference of what? 16,300 here. That's a temporary difference. So we say 16,300 multiplied by 0.29, then it gives 47, right, 27, which is a deferred tax liability. However, when we go to the current year, we are no longer going to have a change because SARS said they will align with our policy, which means we will value inventory the same from 2014 going forward. And this is the wording that they gave. But they will accept the new inventory valuation method from 2014. So therefore, we are not going to have a difference in the year 2014. There is no impact in terms of deferred tax there. Right? Are we on the same page on that?
Yes.
Sharp. We are done calculating deferred tax here. Right. We are done calculating deferred tax, and then we close the calculation. So 88,000 plus 33,750 right? I don't think that figure is correct. It's 900,000 minus 562,500. That, sorry, 900,000 minus 562,500. All right, that's correct. Plus 88,000 plus 29,250 plus 16,300. Then we are sitting on 471. All right, 050 times 0.29. Then we are sitting on 136,605. Right, 110,000 positive minus 24,000 plus 243,750. Right, then we're going to have 329, right, 750 multiplied by 0.28. And then we're going to have 92,330, which is a negative amount. Right, as usual, we then say movement in temporary differences. Right, then we take the current year, positive 329,750. Right, then we subtract the prior year, which is 471,050. Right, 329,750 minus 471,050. Right, we are going to have 141,300, which is a negative amount, times 0.28, which is the new rate. And then we have change or movement in deferred tax, which is 39,564, and that's a positive amount. Right, any questions on what we have on the board? Are you okay?
Sorry, sir, can you please repeat?
Right, on the, which one am I repeating now? The movement.
Yes, please.
Right, on the movement, remember, once you have your totals, you take this one. So you take the temporary difference for the current year minus the prior year. All right, so we had a positive amount of 329 minus 471. It gives a negative 141,300. Then to get this figure, remember the rate is 28%, so we just multiply that by 28. But remember, if the temporary difference is negative, then the deferred tax will be a positive amount.
All right.
Okay.
It's clear.
Right, so I think today the class was very slow. I'm not sure why. Let's hold it here. We are still going to have our class. I think we normally have it on Tuesdays, isn't it?
Yes.
We'll meet again on Tuesdays. I will probably bring something similar, maybe with some additional things, or I will just finish this question. Okay? We'll see what
All
we
right.
do. But go and practice what we have done and make sure you are sharp on Tuesday. It will help you to understand it more if we do the same question and we do it up to the end. Okay?
Okay. So can you move to the last calculation? I haven't jotted them down.
All right, so these ones.
Last.
All
Not
right.
this one. The last one that you were showing. Yes, please.
All right, sure.
Okay, thank you.
All right, so thank you. I will share later in the day. Thank you.
No problem.
Sharp.